Hey guys, welcome to the first episode of Mercury Securities Investing Basics. In this episode, we'll be discussing what is a stock. So, a stock simply represents ownership interest in a company. Say I own 10 shares and there are 100 shares in the company, I would own 10% of the company. Alright, so a stock gives investors certain rights, such as the right to receive dividends declared on the stock, the right to vote on issues at the annual general meeting and extraordinary general meeting. So, annual general meetings or AGMs are meetings that happen annually, as the name suggests, and is for shareholders to vote on routine issues such as a vote on who should be on the board of directors, to vote on approving a dividend, as well as to vote on management compensation. So, while an EGM is for more pressing matters, more urgent matters, such as a takeover offer from the company or merger and acquisition transaction. So shareholders get to vote to approve that during EGMs if such things do happen. So in most cases, investors' losses are limited to the amount they invest in the stock. So that is another benefit of a common stock. And the net profit and the assets of a company belongs to the shareholders actually. Management is the custodian that manages those assets for the benefit of shareholders. Alright, so besides the rights I talked about earlier, why do investors invest in stocks? Well, there are three main reasons. One is for capital appreciation. A good company is able to increase profits at a faster rate than inflation over the long term. And according to the fundamental school of thought, rising profits over the long term should lead to higher share price. So if your profits rise faster than inflation over the long term, your stock should appreciate faster than inflation over the long term. Another reason to invest in stocks is a dividend that the stocks pay. Mature, well-run companies are able to pay a consistent stream of dividends, hence acting as an attractive source of passive income for investors. Finally, stocks help investors reduce their risk. Adding stocks to a basket of other assets such as real estate and bonds could make the basket less risky because stocks are affected differently or by different degrees by various risk factors that affect other asset classes. Hence, adding stocks could be a diversifier of risk. Okay, what kind of stocks make a good source of passive income? These tend to be mature companies with stable profits without much opportunities to reinvest their capital. Hence, they tend to return their capital to shareholders, and that could be in the form of dividends. Of course, investors should look for companies with a track record of increasing their dividend to ensure that the income do somewhat keep pace with inflation over the long term. And the dividend payout ratio should not be too high. So if profits do fall, there's less risk of the company cutting their dividend, as they could still afford to pay the dividend. What kind of stocks are good for capital appreciation? Stocks that are good for capital appreciation tend to be less mature companies with a long runway of growth. These companies should be able to reinvest their capital at high rates, hence creating significant value for shareholders over the long term. But however, growth stocks tend to trade at higher valuations than value stocks or more mature companies. Hence, investors need to be cautious not to overpay for growth stocks, as price is a significant component of returns over the long term. Alright, so thank you for joining us in our first episode of Mercury Securities Investing Basics, and I hope you'll join us for future episodes. Thank you.